On October 24, 1929, the United States financial system transformed in an instant. The Roaring Twenties evaporated, plunging the country into a catastrophic economic crisis. The stock market crash of 1929 left no fortune unscathed, and it all began on Black Thursday, when Wall Street witnessed the most devastating single-day stock market decline in history, a grim prelude to the Great Depression. The Money Trail, investigating the '29 crash, delves into one of the most perplexing questions in financial history. Was this collapse orchestrated, or was it an unfortunate accident? To answer that question, we must first comprehend the sheer scale and impact of the crash itself. The New York Stock Exchange, symbolizing America's post-World War I prosperity, had attracted millions of investors seeking to profit from a booming stock market, its total value reaching an unprecedented high of $87 billion. However, beneath this apparent success lurked dangerous speculation and rampant margin trading. Many investors bought stocks with borrowed money, expecting the value to rise so they could sell at a profit, pay back their loans, and keep the difference. As more people jumped on the bandwagon, stock prices skyrocketed, creating an unsustainable bubble. On that fateful Thursday in October, panic-stricken investors attempted to sell off their stocks en masse, but there were no buyers. A record-breaking 12.9 million shares changed hands, and by day's end, the market had shed $14 billion in value, erasing a decade's worth of gains. The crash didn't just affect brokers and bankers, its repercussions reached every corner of society. Unemployment rates soared from 3% to nearly 25%, and millions lost their homes, businesses, and life savings. The devastation triggered a chain reaction, plunging economies worldwide into chaos, a financial catastrophe unparalleled in history. But the question remains, was this collapse an unfortunate accident or a manufactured disaster? Tune in to The Money Trail as we meticulously examine the events that led up to the '29 crash and explore the potential forces at play, shedding light on the people and institutions whose actions may have contributed to the greatest financial crisis of our time. 1929. A pivotal year in American history, but not for the reasons one might think. Beyond the surface of jazz music, flapper girls, and silent movies lies a far more sinister tale, that of an economic bubble inflated to bursting point. The stock market had been on a steady rise since the end of World War I, spurred by speculation and easy credit. By 1928, this bull market was in full swing, fueled by the belief that share prices could only go up. Investors were borrowing money at unprecedented rates to buy more stocks, creating what we now call a speculative bubble. One man who saw this coming was Roger Babson, an economist and business analyst. In September 1929, he warned of an imminent stock market crash, stating, "Sooner or later a crash is coming, and it may be terrific." His prophecy would prove eerily accurate. However, there were others who actively contributed to the swelling bubble. The Federal Reserve, for instance, kept interest rates low throughout the '20s, encouraging borrowing and spending. Banks, too, encouraged customers to invest in the stock market, sometimes even using depositors' money without their knowledge or consent. By late 1929, the bubble was ready to pop. On October 24, panic selling led to a record-breaking 13% drop in the Dow Jones Industrial Average. This day became known as Black Thursday. Despite attempts to stabilize the market, including a famous buying spree by wealthy industrialists, the damage was done. On Tuesday, October 29, known as Black Tuesday, the bottom fell out. Over $14 billion were lost within a single day, equivalent to over $200 billion today. The dream of instant wealth turned into a nightmare for millions. So, was the 1929 stock market crash an accident or a manufactured disaster? While natural market corrections certainly played a role, it's clear that many institutions and individuals contributed to the creation and exacerbation of the economic bubble that led to the crash. Tune in next time on The Money Trail as we continue to unravel this financial whodunit. Welcome back to The Money Trail. As we've seen, the 1929 stock market crash was a catastrophe that turned into a nightmare for millions. But what factors contributed to this financial disaster? One key element was the rampant speculation, margin buying, and leverage that permeated Wall Street in the Roaring Twenties. Speculation is simply betting on future price movements without any intention of delivering or receiving goods or services. In the years leading up to the crash, this practice became more and more common as investors hoped to make a quick profit by jumping in and out of stocks at just the right moment. Margin buying took speculation to another level. This risky strategy involved borrowing money from brokers to buy even more stocks than one could afford with their own cash. The loans were secured by the stock itself, which meant that if the stock price fell, the investor would be required to deposit additional funds or sell part of their portfolio to cover the losses. Leverage is the ratio of debt to equity, and it can magnify both gains and losses. In the run-up to the crash, leverage levels were astronomical. For instance, in September 1929, just before the market peaked, investment trust companies that pooled investors' money to buy stocks had a leverage ratio of 6.51. This meant that for every dollar of equity, they had borrowed 6.5. These high levels of speculation, margin buying, and leverage created an unsustainable economic bubble. As long as stock prices kept rising, everyone was happy. But when the bubble burst, it led to a vicious cycle of panic selling, plummeting share values, and mounting debts, ultimately resulting in the 1929 stock market crash. Join us next time on The Money Trail as we delve deeper into this financial whodunit and examine how various market participants, including banks, brokerage firms, and individual investors, contributed to the disaster. Stay tuned. As we continue to unravel the mystery of the 1929 stock market crash, let's turn our attention to Wall Street, the heart of America's financial district. Some argue that it was not just a market bubble bursting, but rather a calculated move by some powerful players in this dense network of banks and brokerage firms. One name that frequently arises is Richard Whitney, a prominent figure at the New York Stock Exchange. In 1929, he was vice president of the NYSE and president of the influential investment bank J.P. Morgan & Co. Interestingly, on Black Thursday, October 24, 1929, Whitney famously stepped in to buy stocks when panic selling threatened to spiral out of control. However, his actions were merely a band-aid on a gaping wound. Behind the scenes, there were others who may have profited from the ensuing chaos. Take Charles Mitchell, chairman of National City Bank. He aggressively pushed stock sales to customers, often encouraging risky investments. Even when warned by colleagues about potential dangers, Mitchell reportedly replied, "I don't care whether it's safe or not, I'm going to get the money anyway." Meanwhile, pool operations, groups of investors who secretly agreed to buy and sell among themselves to manipulate prices, were rampant on Wall Street. These schemes created artificial demand, driving up share prices until they became untenable. When the bubble burst, these same shares plummeted, leaving countless investors with worthless securities. And then there's the matter of margin lending, where brokers loan money to customers to buy more stocks than they could otherwise afford. This practice amplified both gains and losses. As share prices climbed, borrowers appeared richer, prompting them to take on even more debt. But when shares plunged, they were left with debts they couldn't repay, exacerbating the downturn. So, was the 1929 stock market crash manufactured or an accident? While it's impossible to pinpoint a single cause, it's clear that some on Wall Street played a role in creating the conditions for a market collapse. In our next segment, we'll explore how these actions impacted regular investors and contributed to one of the worst economic crises in history. Until then, this is The Money Trail. Remember, if you enjoyed today's program or found it informative, please share it with others. Together, let's uncover the truths behind the world of finance. As we delve deeper into the causes of the 1929 stock market crash, it's crucial to examine the Federal Reserve's monetary policy during this time. The Federal Reserve, or the Fed, is the central banking system of the United States, responsible for managing the country's money supply and interest rates. Its actions leading up to the crash played a significant role in creating an economic powder keg, waiting for a spark. In 1928, under the leadership of Benjamin Strong's successor, George L. Harrison, the Fed made a series of decisions that would ultimately have disastrous consequences. Hoping to curb stock market speculation, they decided to aggressively raise interest rates. Between 1928 and 1929, they increased the discount rate from 3.5% to 6%. This action effectively made borrowing money more expensive, intending to slow down the overheated stock market. Unfortunately, these actions had unintended consequences. As interest rates rose, businesses and farmers found it increasingly difficult to obtain loans for operations or expansion. Many were forced to cut back on production, lay off workers, or even declare bankruptcy. At the same time, higher interest rates made it more attractive for investors to hold onto their money instead of investing in stocks, further dampening the stock market. Meanwhile, regular investors, lured by promises of easy profits and reassured by bankers and brokers, continued to pour money into the stock market. With little understanding of the risks involved or the impending collapse, many individuals ended up heavily invested in the market just as it was about to crash. As we approach Black Tuesday, the day the stock market crashed on October 29, 1929, the Fed's monetary policy had created a precarious situation. Regular investors were largely unaware of the dangers lurking beneath the surface, while businesses and farmers struggled with the consequences of higher interest rates. The Federal Reserve's actions set the stage for one of the worst economic crises in history, leaving millions unemployed and financially devastated. The question remains, was this a manufactured crisis or an unfortunate series of events? Join us next time on The Money Trail, as we continue to unravel the complex web of financial decisions that led to the 1929 stock market crash. As we delve deeper into the causes of the 1929 stock market crash, a crucial question emerges: to what extent was insider trading and suspicious activity involved? The term insider trading refers to the illegal practice of trading on the stock exchange to one's own advantage through having access to confidential information. In the months leading up to Black Tuesday, there were indeed signs that something was amiss. One notorious case involves Richard Whitney, a respected figure at the New York Stock Exchange and vice president of the NYSE's Board of Governors. In August 1929, just 2 months before the crash, Whitney borrowed heavily from several banks to buy large quantities of stocks, artificially inflating their prices. When the bubble burst, he defaulted on his loans, leaving behind a trail of financial ruin. Another red flag was raised by certain members of the corporate world. Insiders at companies like Radio Corporation of America and Steel Corporation sold off significant portions of their own shares in their respective companies in the days and weeks prior to the crash. It's worth noting that these same individuals had been buying up shares for months, if not years, before this sudden sell-off. Perhaps even more alarming is the role played by certain banks. Morgan & Co., for instance, quietly began pulling its money out of the stock market in September 1929, well ahead of the crash. This move was mirrored by other banking giants like Chase National Bank and National City Bank. Such actions suggest that these institutions had foreknowledge of the impending disaster. These examples represent just a fraction of the dubious activities taking place in the lead-up to the 1929 stock market crash. While it's impossible to definitively prove collusion or premeditation, the patterns of behavior exhibited by key players strongly suggest that they were aware of the risks and chose to act in their own self-interest. So, was the 1929 stock market crash manufactured or accidental? The evidence points towards a perfect storm of both, a situation exacerbated by greed, poor decision-making, and willful blindness. But as we continue our journey down the money trail, we'll keep exploring this question and many others. 1929. The year that would change the financial landscape forever. At this time, government regulation of the stock market was almost non-existent, a fact that many argue contributed significantly to the crash. The Securities and Exchange Commission, or SEC, wasn't established until May 1934, 4 years after the infamous Black Tuesday. Prior to this, there were no federal laws requiring publicly traded companies to disclose financial information regularly. This lack of transparency created an environment ripe for manipulation and deceit. One notorious example is the case of Richard Whitney, a prominent Wall Street broker and president of the New York Stock Exchange at the time. Unbeknownst to most, Whitney had been embezzling millions from clients and using their funds to support his lavish lifestyle and prop up failing businesses he had invested in. When the market began to tumble, instead of admitting his wrongdoings, Whitney chose to participate in a futile attempt to stabilize prices by buying stocks at artificially high levels, actions that ultimately worsened the crisis. On October 24, 1929, panic ensued as investors tried to sell off their shares en masse, leading to wild fluctuations in stock prices and widespread bankruptcy. Despite calls for intervention, President Herbert Hoover refused to intervene, believing that government interference would only exacerbate the problem. However, critics argue that had proper regulations been in place, such as mandatory audits and disclosures, many of these fraudulent activities could have been detected earlier, potentially mitigating some of the damage caused by the crash. In fact, Senator Peter Norbeck proposed legislation in 1928 that would have required companies to provide regular financial reports, but it was rejected due to strong opposition from business leaders who claimed it would stifle economic growth. Looking back, one can't help but wonder if such regulations might have made a difference. As we delve deeper into the story of the 1929 stock market crash, it becomes increasingly clear that while individual actions played a significant role, the absence of adequate government regulation certainly facilitated an environment where unethical practices could flourish, ultimately setting the stage for one of the most catastrophic financial events in history. 1929 serves as a stark reminder of the consequences when greed and speculation run unchecked in financial markets. The devastating crash led to profound changes in regulations designed to prevent another Great Depression. In 1934, Congress established the Securities and Exchange Commission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. One of the most crucial reforms was the implementation of strict disclosure requirements for publicly traded companies. The SEC now demands regular financial reporting from these entities, ensuring transparency that helps prevent manipulative practices like those employed by infamous stock manipulator Joseph P. Kennedy. Kennedy's exploits were emblematic of a system where unethical behavior could thrive without oversight or accountability. Additionally, the Federal Reserve Act was amended to grant the Federal Reserve more authority over banks and financial institutions. This included the creation of the Federal Deposit Insurance Corporation in 1933, which provides deposit insurance for depositors in U.S. commercial banks and savings institutions. Such safeguards serve as a backstop against bank failures that can trigger widespread panic and economic downturns. The Glass-Steagall Act of 1933 further separated commercial banking from investment banking activities, aiming to prevent the kind of reckless speculation in which banks like J.P. Morgan & Co. engaged during the Roaring Twenties. This law stood until its eventual repeal in 1999, a move many experts argue contributed significantly to the 2008 financial crisis. Today, we find ourselves at another crossroads. Memories of past calamities fade over time, and calls for deregulation grow louder. Yet history teaches us that without proper safeguards, our financial system remains vulnerable to catastrophic failure. The 1929 stock market crash was not an accident, but rather a manufactured crisis born out of greed, unethical behavior, and insufficient oversight. As investigative journalists, it is our responsibility to shine a light on these critical issues, reminding policymakers and the public alike that financial stability requires eternal vigilance. Only by learning from past mistakes can we hope to build a more resilient financial future.